Morning pointing to a decline at the start of trading. We are all waiting on the banks. They are reporting their fourth quarter earnings this morning. Typically, that is certainly a market mover, and it will set the tone for markets. J.P. Morgan, Citigroup, and Wells Fargo will report their fourth quarter earnings before the opening bell today. Joining me right now to give us a sense of where we go from here is Lebenthal Global Advisors President Dominick Tavella. Also joining the conversation all morning long this morning is Fox Business's Dagan McDowell and the King's College in Manhattan Professor of Business and Economics and Fox News contributor Brian Brenberg. Great to see everybody this morning. Thank you so much for being here. And Dominick, let me kick it off with you. We got the banks out this morning. What are you expecting that, and will that, do you believe, set the tone for markets over the near term?
Sure. So the last quarter, the banks really surprised us. They had much better earnings and growth than we had expected, and the prices have reflected that so far year to date. But ironically, BlackRock announced yesterday, and they really had killer growth and AUM growth and profits, and yet the stock was down almost 5%. So I think a lot of analysts have built in a lot of expectations. I do think this is a great sector to be invested in the rest of this year. We could see really good numbers, and yet the stocks pull back a little bit because the expectations are a little bit too high. But I think the XLF, the financial spider balance of this year is a great place to put some money in the balance of this year. If you get an opportunity to buy it a little bit lower, terrific opportunity.
Yeah, I mean, you have to believe that the value is there, Dominick, given the fact that these stocks have been among the weak spots for this market. And also, we're going into a period where many people expect the economy to improve. That's also a positive for the banks.
Absolutely, Maria. If you look at these banks just as a category, again, I'm targeting the XLF as an indicator. Over the last 12 months, you literally made zero. I mean, year to date, it's up very nicely, but the last 12 months, you've made no money whatsoever. And if you look at, of course, as the S&P as a comparison, you're up about 20%. So you look at higher interest rates. We've already seen the 10-year go over 1%. They have a ginormous amount of reserves, expecting loan losses, mortgages, credit cards, and the the regulators have loosened up restrictions on buybacks and dividends. I think this could be a very good sector the balance of the year.
Let me ask you about mortgage lending. The Trump administration announcing that it is stopping its push to restructure taxpayers' stake in the mortgage giants Fannie Mae and Freddie Mac. So now it's up to the Biden administration. This ends the administration's efforts to return the companies to private ownership after being placed in government control following the 2008 financial crisis. It is now up to the incoming Biden administration to decide the firm's future. Dominick, you know the shareholders in Fannie Mae and Freddie Mac want to get paid here, and it's been several years. What's your take on the implications of the Fannie and Freddie still being in government ownership?
So just a quick background, right? The government put up $190 billion back in 2008 to basically save Freddie and Fannie. Of that $190 billion, they've recouped $300 billion plus just in dividends and profits. That means Fannie and Freddie still owe the government $190 billion, the original investment. They've recouped $300 billion in profits off of these companies. So whenever Fannie and Freddie made a profit, that profit was being swept back into the Treasury. Obviously, the investors in those companies aren't really happy about that. They would like to see some of that money come back to them. This is the first step to eventually letting Freddie and Fannie go off on their own. They're going to be able to retain their earnings. Now, the guise is that they're going to retain those earnings so they can build up reserves for the next crisis. But the truth is, at some point, the U.S. government, the Treasury, will sell off its shares, its interest in Freddie, and they'll be gone. This is the first step, but it's really going to be up to the Biden administration to put the ball forward from where we are today.
Yeah. For sure. Dominick, it's good to see you this morning. Let me bring in Brian Brenberg here. Go ahead, Brian.
Yeah, Dominick, good morning. I'm watching markets react last night to the Biden stimulus plan, and I'm seeing sort of a muted reaction. I think investors have been excited about the sugar rush of more government money, but it seems like some of them are now starting to think, well, this comes with strings attached. It's not just free money, but there could be higher taxes down the road, especially as Biden is talking about a phase 2 climate change and, regulatory change and infrastructure plan coming after this stimulus. So what do you say about that? Are investors starting to get the sense now? Are they starting to wake up to the idea that taxes might be on the rise, and some of these climate change policies might hit companies from a regulatory standpoint?
Great question. So we see the reaction this morning. At best, it's lukewarm. So I think it's a combination of two things. One, helicopter money. We just can't drop money from the sky and cover the entire planet with this. So the resources need to go to a very targeted people that really need it. And I think from the speech last night, we're getting a sense that these dollars are going to be very targeted, and Biden is not going to get everything that he wants. And then the second part to your question, somebody's got to pay for this, and it's no free lunch. Now, we can keep adding debt and keep adding debt, but there will be a price to be paid on this, and it could be higher taxes. It could be more regulation, and certainly the issue of climate change is going to add cost, operational cost to corporate America. All this will dampen economic growth. So markets are starting to realize that it's not going to be a free lunch here.
Yeah, well, that's true. And the markets so far have not really focused on debt. But we've seen interest rates start coming up. We've seen a pretty good move over the last couple of months, 6 months or so. So we'll see whether or not debt becomes a problem for markets. That can happen quickly. Dominick, it's very good to see you this morning. Thanks very much. We'll see you soon.
Thank you, Maria.